Hi everyone, welcome to a new episode of Beyond the Balance Sheets. Today we're meeting one of Europe's fastest growing brands, CDLP, and we will deep dive into their international expansion, the tech stack that they use that have enabled this expansion, as well as the importance of communication. And of course, their favorite Excel shortcut. My name is Ruben Arnbert, I'm the CFO of Juni. Let's do this. Welcome, Jesper, Borulf, CFO of CDLP, and Gabriel Nelsson Vedung, Head of Finance at CDLP.
Thank you, Ruben. Happy to be here.
Great. Well, it's great to have you here. And as we mentioned, or as we started with, one of the kind of holy grails of many e-commerce brands is getting into the US market or the international expansion piece. So how did you do it?
So we back in the days we started off by getting into the really important department stores from the start. So the B2B players, we used that as an acquisition tool to establish the brand and to get the customers on board. So the founders Andreas and Christian did a tremendous job in establishing the contacts necessary to find a way into those prominent venues. And little by little, then people get to know your brand, and then that spilled over into the online channel, and suddenly you have an established customer base over there that you can.
So that was essentially the sequence: find kind of key wholesale retailers, establish the brand, reach kind of critical scale, really, and then on top of that, layer an online channel.
Correct. And we also one of the first employees was a head of PR back over in New York. That helped us tremendously to get the right contacts and to launch the brand. So that was really key.
Not to mention the various press features that we got through this man that really put, because underwear it's not visible in general when you see it on people. So what the strategy there was really just put the underwear on the right people. So when styling models or when styling celebrities, CDLP should be the underwear you go to. And then little by little, we got there.
And have you followed a similar pattern? Like, have you established kind of a GTM machine where you used a similar pattern in other markets? Or has it been different when you go into, for example, Germany and your German expansion?
Yeah, I would say US is a case in point where the wholesale expansion was so key. Sweden, to some extent, we as well with NK, where we got an early traction, spreading the message in Sweden. London is another one where the wholesale partners played a key role, and those are our three main markets.
Okay, so in your US expansion, what role has the finance team held in that, or your other markets for that example?
Well, from a finance perspective, we managed together with the e-com team how we spend the marketing dollars, not only in certain states, but also in terms of how much we spend in each state. So it is very important for us in the finance team to make sure that every dollar spent generates a certain amount of revenue, and importantly that it's also profitable. And in recent years, the pressure of profitability has increased substantially. So now, whereas investor sentiments before allowed us to maybe spend marketing money to get a certain reach, not necessarily profitable, the main objective nowadays is to really go for profitability very early on, and not to let it go too much time before you reach that threshold.
Yeah.
And I would say that the finance team has assumed a very critical data aspect of the business. So we've essentially, since I started around 2 years ago, we've taken a much more granular approach to how we predict and how we look at different markets. You know, we have price discrimination. We sell to different prices in different markets. We have different margins in different markets, which follows from that. Also different distribution costs in different markets. A lot of US customers pay with MasterCard, with American Express, and that costs a lot more. So we have to look at the contributions for every single customer or every single cohort of customer and see, okay, now as it stands right now, we have a very big surplus in this market, let's say Austria. Okay, so then now next week we'll shift the spend to Austria, make sure that we reach break even on those new customers, and in effect get more new customers in Austria and build a following there. So I would say, except for the market, the US market, as you say, where there was a more directed approach, wholesale expansion, PR guy on site. Now we're more driven by, we go where the market wants us.
And now where you find the contribution margin.
Where we find a good contribution margin.
Exactly.
So Sweden right now, for instance, the wallets are very tight. So we pull back spend because we see that the new customers here, they don't have that high average order value. The prices are much lower here. Even though, the other variable costs, such as distribution, is better, it's still not a very profitable market. So we hang back here for a while.
Yeah, and I think a lot of operators can relate to that, right? That you used to have a market where growth was valued a lot higher, or reach, or brand building, and then you have what feels like an overnight shift into kind of hard profitability or contribution margin, right? So, I mean, obviously something must have happened in the US for you to decide to open up your stores there rather than somewhere else. So was it only contribution margin that aided in that decision, or what kind of drove the decision or the recommendation from finance to say this is where we should deploy capital?
The way we see the most traction is in the US. We believe the thesis that we have is that if we establish a retail presence in the US, that will then have spillover effects on the online business. We saw that in Sweden, for example, when we opened the Sweden store, that the Sweden market back then, this is a couple of years ago, then you get a quite nice traction on the online piece. That you then put that into an American context, and of course the volume is way bigger. So we hope that it's going to have a big effect on online.
Yeah. We have from our expansion into the US and the PR on site, what I feel is we got somewhat of a cult following in New York, in LA, and to some extent in Miami as well, which is where we're looking at opening the stores to make more people, because obviously the New York stereotype person likes what we're selling. We sell most in those cities. So it's all about us making ourselves known over there. And wholesale does that to a great extent, but having your own space that you can fully dictate the terms of, and how you present your wares and things like that, I think it's
and obviously just staying on the contribution margin piece, given how in the important
that's key as well.
Exactly.
Key,
but if you kind of look at the margin, is that coming from a higher LTV in the US, i.e. more repeat customers, or have you adjusted the cost base, or maybe both?
The price point in the US for us is higher. That's one driver. The retention is stronger as well, driving CLV over time.
That's the type of growth you want. Right?
Yeah. And it's also, I think Americans are richer. Like they have more cash on hand to spend at all times, and I think actually our price point, while it might seem high in Sweden, for instance, or maybe in some parts of Europe, it's quite low for the segment that we currently brand-wise exist in. So you can buy our stuff, still feel very luxurious, even though you pay less if you are an American. But then also, as Jesper said, retention, great in the US, really great. They love swimwear, and swimwear is one of our best margin products. So they buy a lot of swimwear. The New York people going down to Florida on their spring breaks and having a swim. So just great unit economics overall in the US, except for the distribution piece, which is quite expensive.
And would you say, I mean, we've touched upon this already, but we've seen an economic downturn past 2 years, higher inflation, less disposable income. Has that kind of elasticity of demand been different in the US versus other markets and have driven this decision? Or is it simply that, well, you have more brand equity in the US, like you mentioned, higher disposable income from the start?
I believe the price sensitivity is less in the US. We haven't seen over the last 2 years the same contraction as we have in the other markets. But the other markets are still growing, but US seems to be sort of insulated in our customer segment against the macro and the disposable income reduction.
Yeah.
At least that's what we see in the data.
We've reached a certain customer there that we haven't really reached in such a wide extent in other markets. We see it to some extent in Germany. It's got great growth. Austria, Switzerland, to some extent the UK as well. Yeah, so it's a different segment in entirely, which is funny because we have the same brand identity, at least according to us, across the globe. We display the same advertising everywhere, but for some reason they picked up on something. Maybe it's European flair that they like. I don't know.
In contrast, you have Sweden, where the last 2 years you can really see the contraction in disposable income among the customers. It's quite astonishing. Yeah,
and it's funny. There's a recession indicator that is historically you can see almost a direct correlation between recession and underwear purchases. So when times get tough, men don't buy as much underwear.
Oh, really?
Yeah,
they turn them inside out.
Yeah, exactly, exactly. Multiple use.
Yeah.
So and it's funny. I mean, we're seeing this in some markets. That ever since the yield curve started turning, the underwear sales started dropping off a little bit.
And you mentioned obviously there's been a process not only for you but the entire industry in this focus on profitability. Capital is not as cheap anymore. There's not as high premium on growth as we've seen. What concrete changes did that lead to in your way of working? I mean, you mentioned, Gabriel, that you've now essentially switch off campaigns in your performance marketing faster, for example. And I guess that also puts a requirement on how fast the finance team can be this data expert and deliver these insights. Hey, this is performing, this is not performing.
At CDLP, it's a very iterative process together with the marketing team and the e-com guys. We speak to them, I would say, daily to see where to allocate the spend in the most profitable way. So I think you need to be very agile and quick on your feet to spend the money wisely in this climate. We sort of run the model by country, by customer type. It's very detailed dialogue together with the rest of the team.
Engineering of customer journeys to make sure that we funnel them into the best products, the most retaining products, so that these customers in the long run become more and more profitable.
But I guess then in practice, it's fairly, I don't want to say standard things, because frameworks can be used everywhere, and how well the framework works often depends on execution. And what I mean by that is that I guess you have a set of KPIs that you target, but the most important part is how do you act when you have those KPIs, i.e. what is the threshold for action, right? So which top 3 KPIs do you use that drive action to avoid having a dashboard of 100 KPIs and you can say, hey, I know exactly what's going on. Okay, but what action are you taking on those?
We in the earlier days we had this massive KPI dashboard that we built to run the business, and I suddenly in time realized it got way too complex. So over time we have to trim it down substantially. I would say now today we are looking at maybe top 3 or 4 KPIs.
Which ones are those?
CAC obviously is the main one in the online channel. Retention is another one. CAC is more sudden in a way. You can and you have to react on it if you see changes in the various markets. Retention is a little bit longer in
further down the road.
Yeah, further down the road, but you need to keep an eye on that as well per market to ensure the LTV increase.
So what CAC threshold do you accept? Like, let's assume that Austria is now 10% above the CAC that you thought you would get. Do you turn off Austria, or?
We decrease it. Right now, historically, as we prioritize growth, we look at a CLV over CAC ratio, which historically has been very good. But now, as we, cash is king right now, we want to keep our coffers tight. We simply just say at profitability. So if they're not profitable on first purchase, long term they can still be profitable even though we overspend. But if they're not profitable at first purchase, we cut it off. So GM3 in that sense, the contribution is a very important KPI that we also look at.
Cost of sale is another one. Marketing spend divided by online revenue is also up there in the top 4. I would say a shift in cost of sale of 2 to 3 percentage points will set off the alarm bells in the finance team, and then we go and speak to marketing guys and see what's going on.
It's really good then to have this granular approach, because then you can instantly see we're at 22% now. We're supposed to be at 18. What went wrong last week? Okay, we saw that the algorithm pushed sales into this market where we obviously didn't get any customers. Cut it off. Modify the algorithm, train it again.
You have to run the company a little bit like small mini companies in each country. So US is one company, UK is another one, Sweden is another one, and they have their separate models, which then of course consolidates up in the total. But when we look at it in finance, it is very much country by country analysis. And then in those countries, you have new customers, the CAC, the cost, and then you have the retention and returning customer revenue. So you track all of that at the same time. So it becomes a massive spreadsheet, and then you have to single out the key KPIs in that. And then for us, it's then CAC, cost, retention.
Another important, it's not top 3, but important these days is inventory coverage per SKU or per product category. We placed a lot of bets since I started on new categories. We started selling women's underwear, women's swimwear, just keeping a tight eye on that. See which products are not performing, which products do we just get rid of right now, fire sale or whatever, just to keep having that cash buffer at all times. It's material, it's paramount to do so in these times.
Runway, I have to mention as well, is also top of mind in the finance team.
Every day I look at that. I look at the little squiggly line of the cash.
The cash flow projections is absolutely essential in our business, and to have enough cash buffer to manage uncertainty, especially in a year like 2024, is very important.
No, but it's interesting because you obviously mention inventory, you mention cash flow forecasting. And in our experience, what we see with a lot of customers is that the role of the CFO or the finance team is changing in a way. And what I mean by that is that they're becoming more operational in the sense that in order to make this analysis or make these forecasts more accurate, you need to have a deep understanding of how the business operates, right? Otherwise, you'll end up in a forecast which is detached from reality.
It's also important that you've established the finance function as a center point of the organization. So like the finance team cannot be some satellite office sitting on the top floor that comes down and chat to you every now and then, but you have to integrate it into people's everyday life and make people sort of comfortable with financial concepts, so you can talk to them from a financial perspective to drive the agenda that way.
Yeah, especially in these times when we flip every single crown that we have to make sure that it has some contribution to the overall business, and to not get sad faces when we cut the content production budget. If we cut a third of that content production budget, it's really important for people to understand why we have to do that.
So how do you handle that in practice? Like, do you hold kind of separate meetings with the teams, obviously, like all hands with the business? How do you educate financial thinking, as you put it, within the organization?
I would say team offsites is a good opportunity to sort of convey financial messages and show people, which are in our firm is often creatives, so they're not so financially, I wouldn't say interested, but financially finance is not top of mind for many of the creative souls at CDLP, and then
but it's also not their job.
Yeah, exactly.
Yeah.
And it's a nice dynamic to have that, where we often are a little bit holding back on the creative sprints that people wants to do. And so from a money perspective, is this really a high ROI investment that we should be making? Are you sure about if this is gonna be offering high enough returns?
It's good that we have a very like collaborative approach, me and Jesper, to spreading financial knowledge in the business. It's all in the slides, really. So like I can produce something, and Jesper says no, you have to boil it down. You have to make it simpler to understand, because we're in this bubble all the time where we talk about CAC, we talk about cost, we talk about contribution, but that's Mandarin Chinese to a lot of people. So it's very good to have two people looking at the same thing and empathizing with the others in the organization to know what will they understand. what do we feel is most important for them to understand, and how do we make sure that they grasp it in a good way. And I think we've succeeded quite well in that.
No, I think actually the physical placement of the finance team matters. It might to sit in the middle and then on a daily basis talk to the teams.
Definitely.
So make yourself heard and make people comfortable with the concepts is it has proven very important at CDLP. And then you can use the team offsites and the bigger presentations and as well. But the daily interaction, I would say, to drive the growth profitably is absolutely key, especially with the marketing team.
And I mean, coming back to inventory management, and the reason I focus on that is because it's so key for your cash flow forecasting, your working capital cycles. How I mean, you can have different setups where either you have a dedicated operations team which handle kind of logistics, 3PL, etc. How involved, or it can even sit in the finance team. How involved are you in the actual logistics side of the inventory cycle? Or is that something that is separated?
We're very involved. Since we sit on the modeling aspects and we sit on the revenue projections, we are the one who models out the inventory purchasing, both in terms of amounts and timings. Then we speak to the merchandisers to see, okay, we have this revenue forecast. This will require such and such volumes of purchasing. What should we spend on? What products should we spend that purchasing amount on? So, and then we speak to those guys to establish what to buy based on the traction and the trends that we see.
Yeah. Traction. Yeah, exactly. CLV as well. With what's the best funnel for new customers, or for all customers really? What should we buy more of? Really, that we might not see it traction wise, but we can also induce a lot of traction through campaigning, of course. So if we see that if a customer buys a pair of underwear first and then goes into t-shirts, and that leads to retention and customer lifetime value, then we basically instruct the rest of the organization to pivot, focus on this now, which means in turn buy more t-shirts, because we're gonna be marketing a lot more t-shirts for this cohort.
So kind of going towards maybe real time is stretching it, but shortening those cycles significantly.
Yeah. And it also goes into good negotiations with our suppliers, maintaining good relationships with them, so we can keep the lead times short, we can keep the minimum order quantities very low, and payment terms as well. Really, really nice to have good relationships and these times.
Is that something that shifted? Because one thing that we're seeing, especially in the data that we have on our customers, is the trend of nearshoring, particularly for the production, and essentially moving away from Southeast Asia. Certain suppliers are of course still left there, but that particularly after COVID, given the supply chain issues that happened, and also essentially the deglobalization, if I'm going to stretch it, of what has happened since after COVID, an increasing trend of simply using, for example, European suppliers, even though the price point might be higher, because the supply chain headache is way easier. Is that something that has happened in the CDLP journey as well, or Southeast Asia?
We have always been in Portugal, and together with some smaller volumes in Italy. So it's always been relatively close to home. Logistics disruptions hasn't been a big headache from the supplier side. The 3PL partners can vary in quality and service level, and we keep them close to home. So we have ours in Sweden, but also so you just to be able to have a super close collaboration together with them, because that partner is key to swift delivery for the customer.
And other than maintaining good relationships, how do you improve the inventory cycle? I mean, you mentioned earlier the way you monitor and instruct, essentially how you can drive the inventory cycle in general. Is there anything else beyond that has helped you in that journey?
The fact that the producers stock the items for us after production until we call them off has been tremendously helpful in the cash flow cash flow profile. That's the only thing I can think of.
We have, wholesale is very big. It can be a very big headache when we have major wholesale partners that don't really have to commit to anything. So and we have this never out of stock program that is basically an assortment of goods that will always be available to our wholesale partners for reorders. They don't have to commit, which means that we hold a lot more stock. So we've reduced that never out of stock program to narrow it down to fewer SKUs, and that has helped us as well. And also being more firm with wholesale partners on essentially just making them commit to purchasing orders. So whereas we previously might have been more lax, we just want the exposure, we're grateful to be able to be in your wholesale store or online retailer store. Now we're putting a little bit more pressure on partners as well. And they're happy to comply, really. It's just that,
But is that simply down to volume and brand equity of CDLP? I mean, the fact that you now have more leverage against your wholesale providers, or is there anything else that you change in the terms? Or where I'm going at is that we obviously also see with a lot of our customers, especially now in this economic climate, that certain smaller wholesalers kind of use our customers as credit lines, essentially, by stretching the payment days or...
Yeah, no, payment terms on paper tend to be forgotten when it's after a quick intro. Very few wholesale partners stick to those. One thing we have increasingly been using is prepayments from the wholesale partners before we ship the products. That has helped a lot on the AP.
No, but it is definitely, as you say, that especially the bigger players, they don't have to pay us on time.
We are too small for them to respect the contract.
And underwear it's a low margin product, so it's already for them. They don't want to make it a huge investment to sell particular underwear on their sites. They'd much rather sell leather goods and things that they like.
I guess this is where the cash flow forecasting becomes absolutely key.
Yes.
Right?
Yes,
and
absolutely.
Understanding exactly the working capital cycle in detail.
So I think you have to model it almost on a wholesale partner level. At least that's how we do it. So because that their behavior, and that such and such partner, they will slack and pay 2 to 3 months too late.
Yeah.
How does that affect your profile, especially on the bigger accounts? So it is essential.
Yeah, definitely.
It is.
And speaking of tech stack, I mean, there is obviously a whole lot of progress within just the past 5 to 10 years in terms of additional software targeted at finance teams, et cetera, et cetera. Do you feel that has lived up to the expectation? Or because the reason I say this is that at the core of most finance teams today is still Excel.
Very much so.
Even for us, Excel is a huge tool that we use constantly.
I think the whole financial sector of the world almost runs on Excel, which is a little bit scary, to be honest. But it's such a good program. It's so hard to even to not replace, but even complement. It's difficult to.
Is it just the flexibility, or?
Yeah, or mostly the flexibility. I would say.
Yeah.
And
I still struggle to trust the software to come in and replace the human brain together with a solid Excel model. But I'm old school. I think I need to change that mindset in time with the technical developments that we see. But we have tried solutions on the inventory purchasing modeling. We have tried solutions on the wholesale forecasting based on their payment behaviors and such to get some help on those sub models. But I still haven't found anything that really stack up, so to speak.
But what do you think that is? Like, why do you think that especially finance teams are so underserved when it comes to financial tooling?
I think personally, for me at least, we want to remain as agile as we can be. So I mean, we reforecast the business on a weekly basis, and obviously not thorough reforecasts of the entire OPEX side and everything like that, but we still reforecast
the revenue
substantial amounts of the revenue. Example, the online revenue is it can be super volatile if you're not on top of your KPIs. I don't want to go into really an online dashboard and put in my new revenue forecasts for all these markets and all these weeks and all these months every time that I do a reforecast in Excel, which takes 10 minutes to do. So it's really about what I would love to see is an integration into Excel. That could be amazing. But right now the tools are just not adequate enough for our needs.
For me, it's the F2 key.
Yeah.
That I'm missing from every application. Like, how is this calculated? Where is this data coming from?
Exactly.
Savior.
Yeah.
F2 escape.
Totally.
I think I have my biggest digits are a bit impaired after all the usage.
Yeah, no, it really is like that, and that's also an issue with a lot of these tools that you can't really cross-check. So, I mean, the new tech example is AI. A lot of AI players are popping up that are in contact with us a lot, that want to facilitate our working process with AI. And don't get me wrong, AI is great in a lot of use cases. ChatGPT to get the optimal structuring of data or the like. But if an AI comes up with, this is your forecast for the coming 3 months, and I don't know how it got to that point, then I have to do the work
to check it.
Yeah. So that means I'm doing the same work, but it's just cross-checking another output. So it's not there yet. It's not there. Unfortunately, I would love for it to be. It would ease the workload tremendously, but not yet, no.
Okay, so I thought we'd deep dive into the tech stack that you guys use. Obviously, it's one of the hottest topics within finance and the changes that are happening in the tech landscape. But let's start with, what do you use today?
Right. So we have accounting-wise Fortnox for the day-to-day bookkeeping. We have Shopify is the platform for the online piece. Excel obviously sits on top, manages everything. The holy grail. Can't really get rid of.
No other payment gateways. Shopify is the
Shopify is the only one. Right.
Oh, we have Klarna as well, and or maybe that goes through Shopify payments.
Yeah, so I say, okay, you mean payment gateways? Yeah, the Klarna, we have PayPal, Stripe, exactly.
We have as an inventory management system since 7, recently implemented, because we saw that the previous software that our 3PL partner had recommended was not really living up to the promises. So we've just recently implemented that fully. That's going to cover our warehouses, but we can also establish virtual warehouse positions, so we can more closely manage the different inventory levels for different sales channels.
Whereas before there was sort of a competition between the wholesale inventory and the online inventory, because obviously the wholesale revenue drives so much more volume. It's not bigger in revenue, but the number of pieces are so much greater. So then we couldn't really leverage that inventory to use in the online channel. But that will improve massively with this new system. And also own the data yourself instead of the data ownership sitting at the 3PL partner has shown to be key.
Very important
to from a control perspective.
Yeah. We also have ClickSense as a BI tool. I don't know if you said that, but we have that as a BI tool. But we're looking at we're revamping it somewhat to basically rebuild it a little bit, because now it's a little bit, it's kind of a patchwork of different coding consultants doing different work.
Click has sort of been our quasi ERP system in the early years, and still is. And I think if I could go back in time, I would have implemented the ERP sooner. We don't have one today, but to get that
no ERP
today. So Click together with Excel and us, that is the ERP system, and that has proven challenging at times, because you get this stacking of data sources within the Click framework, and as Gabriel said, different coding. And when that start to wobble a bit, it can get quite messy, and then you need to spend money and time on fixing it. Whereas the solution to get a solid ERP from the start, take the cost, I think would have been a better way to do it.
So before, essentially, transaction reconciliation, ledger, journal creation was all in Excel?
Manual.
Yeah, it was in Excel. Yeah.
Okay.
And that takes, it distracts us from doing
Exactly.
the work where we're most valuable, strategic work and the like. A lot of my work has been just ensuring that data is good, and I don't want to sit and do that. I've become really good at doing it, but it's not what passionates me.
It isn't what finance should be doing. Really,
No,
you should have
exactly.
an ERP system to do that.
Yeah.
But I think it's a situation that many end up in. And I mean, similar to us, we were on a journey for using ERP as well, and you constantly balance. When do I take the time to make this investment? Do I have sufficient time to save to warrant going through the ERP process, setting it up, etc., etc.?
My fear was always that the final cost will be 2 times, 3 times higher than what you expected. And at least that's what I'm hearing. But I think it's time for us to implement that.
But in a way, you have to, and this makes it kind of difficult to just make the decision to invest in an ERP or a very advanced BI system. That how do we evaluate our time that would be not spent on focusing on the data. So like if I could have spent X amount of hours per week doing value creation instead, or like strategic work instead, how much would that be worth? I can't really quantify it. So if we have an existing system that works, where I do manual labor in Excel, or it's not manual, but you get what I'm saying. What would I do instead, and how would that contribute to the business? It's very difficult to quantify. So then you make no decision, which is a decision to continue with the status quo.
But at some point, you do obviously reach a point where you changed. What drove you to make that? I mean, at what point did you feel, okay, this is not sustainable, we need to change it?
I would say when we reached a revenue of 70-80 million, there about a year, or is that 1.5 years ago, then I started to feel that it's bloody time to get the ERP system in place. It's not there yet. We still don't have it. But that's when the thought started to arise in my head. And also as you see new countries being added to the e-com channel, and then you have all the currency flows, and you have inventory management and stuff, and then it's just the volume balloons and become sort of harder to manage. And as a consequence, then your local Excel files also balloons.
Exactly.
So then you start to feel, oh shit, I should benefit of having this all in the ERP system.
Yeah. We're doing it in sort of an iterative approach right now. So we have this inventory management system that is almost ERP level, at least inventory-wise, which has been the biggest headache so far, the inventory side of it all. So we're doing that, and that's going to help us a lot in implementing the ERP when we do it, because then we have the data infrastructure in place. We're also revamping our BI system, building it almost from the ground up. And I think those two in tandem, and then afterwards implementing an ERP is going to be quite easy. Oh, quite easy. I'm going to have to eat my shoe after saying that, but easier than just starting from scratch with the full ERP implementation.
No, but I mean, that's what we experienced, that the complexity arose not only from volume, as you described, but also, more importantly, additional countries and additional entities. And not only the FX headache, but also transfer pricing, VAT, and the added dimensions that you essentially can slice and dice the transaction data in. The problem with an ERP is that obviously that helps in structuring to a certain extent, but it's at the end of the day how you use it. And ERP systems are many times very outdated, very old, clunky, and it's difficult to have or mirror that with the type of agile approach that you're using and you've described.
Very true.
But overall, it's a fairly thin tech stack in that sense, that Excel is still at the core.
Yeah, that's the mothership.
Yeah. And I think that's a common misperception as well when talk about tech stack, the modern finance team, that all of a sudden you're going to have 20, 25 tools that all speak with each other. I think that's a myth. And I'm not sure that you will actually achieve the type of efficiency that you expect by adding other or more layers of tools.
You will certainly lose control, I feel, from moving away from Excel being the mother file. At least that's my take.
Definitely. I don't want to answer to anything that I did not really play a part in producing.
Hard to trust a number that pops up in the system.
Yeah.
Moving to a different topic, we've talked a lot about not only cash flow forecasting, inventory management, which is at the very heart of the working capital cycle of an e-commerce business. What does your capital structure look like? How do you set up a capital structure that can adapt to these very quick changes that you've mentioned, being able to turn off or turn on the tap in multiple countries? What does your capital structure look like today?
So historically, we have been equity financed up until maybe 2 years ago. Then when the capital got increasingly expensive and the equity market sort of shut down in a way, we started to use debt financing. And so we have three layers of various debt tranches. We have senior loans, long term. And then for the shorter cash needs, we have, or for the inventory financing especially, we have inventory invoicing financing that we use quite substantially. We also have a short-term revolving credit facility that we draw on every now and then. So that together with the capital raises on the equity side that we've done over the years is now driving the balance sheet.
Right. So let's talk about your capital structure and how you fund the business. Obviously, from a very theoretical point of view, it makes a lot of sense to use a mix of debt and equity to optimize the cost of capital of the business, right? At the same time, by adding debt, you add a fairly big operational burden on the business. Right. You all of a sudden have banks that you need to speak to, you have covenants that you need to adhere to, et cetera, et cetera. So at what point did you decide to go from equity financing to debt financing?
What enabled the debt financing was the closer we got to profitability, then you can start to talk to the banks in earnest, because they will be very reluctant to fund, especially in this climate, to fund unprofitable businesses. So those doors opened up for us when we were, say, 12 months out from profitability, or 24 months out, really. And then that proved the terms that we were getting proved to be more beneficial than to take in more equity, which, as you say, is a more expensive form of capital. And when selecting the lenders, it's always been very key that they don't hamper us on the operational side, so that they don't have too many covenant. Well, our debt financing is very covenant light. There are no covenants really, but it may be seen as a covenant, though. They have operational views on how where we place the inventory, for example. We're not allowed to split up our inventory and have them in different regions of the world, for example. So to find lenders that allow the maximum of operational flexibility is absolutely key.
And I guess the global presence that you have, because you mentioned, I would expect the banks to have a certain amount of jurisdictions where they feel comfortable taking the security, they know the market, they might have local legal advice, and then there are certain markets where they don't, and then boom, tap is off.
And we have stacked 2 or 3 lenders on top of each other, which in retrospect I would say it would have been better to go with one lender, because there will be situations, one lender to take the full control of the balance sheet. There has been situation where they compete with each other, and when they have different views of what we can and cannot do. So it's always easier to just have one counterpart and speak to one lender. So if I could have redone it, I would have gone with just one debt provider instead of the current 3 that we have.
One of the common things that we hear as well is that the lender, which typically lends across multiple industries, multiple sizes of business, that they might not understand the dynamics of your specific business or your specific industry. For example, the working capital issues that are structural to an e-commerce business might not be fully understood by a bank.
The traditional big banks, especially. Yeah.
You have to speak their language when you pitch to them in the same way that you pitch to equity investors, but you just have to shift your focus away from very abstract, futuristic terms about customer lifetime value and the like, and more about measures to implement profitability and to reduce working capital consumption and things like that. I think we've done a good job at communicating that way with the banks.
Are you missing anything from that process? Like, what was the biggest headache going through that process?
Back in the days, 2 years back or so, there was the big banks have this obsession about profitability, which we didn't have at the time. Whereas my need was more working capital financing, short-term stuff, 4-month term. But the only KPI they looked at was the bottom line, which was not what I needed. So that was the main headache in those discussions for me. Because the solutions among the big banks is not tailored. It's not tailored for e-com, really. And they use it seems like they use the same KPIs for when they evaluate all the businesses.
Yeah. I think post raise of this cash, it's the biggest headache has been stakeholder management and they're always involved. A board of directors is also involved, but in a different way. A debt provider can in a sense pull the rug at any time if they see us doing something that they don't agree with, and then all of a sudden we're in a very tight spot because we did something that they didn't like.
Yeah, and I mean, we talked earlier about not only stakeholder management, but how you communicate financial terms effectively internally. So previously we talked about, for example, talking with the marketing team or creatives and educating them in finance. It's a similar dynamic with the banks, but they're obviously not creatives. They might be too number driven or don't understand fully the business model or where you're headed, and thus have an issue underwriting that.
Yeah. I think the modern CFO is a communicator. And,
it's very important.
Yeah, very big part of being a CFO nowadays is
I spend way more time speaking to lenders than to speak to shareholders, for example. They are much more, I wouldn't say nervous, but they are much more financially involved in the business than the equity owners, which are a little bit more relaxed. The equity owners, on the other hand, come with way more strategic advice and stuff, but it's not as frequent. Whereas with the banks, I speak to them almost weekly for an update on the business and so on.
Wow.
So they are a very active stakeholder in that sense.
Which is in a certain way funny because a lot of your transactions actually run through the bank. So they actually sit on a lot of this data already, right? Yeah. But you have to kind of
just want to hear it.
Turn it into a different format.
Yeah, you would expect the equity owners to be the weekly call.
Anyway, I can bash banks all day, but if we kind of look forward, whether we're talking about your capital structure or the business in general, what are the biggest challenges right now that you're focused on?
Cash, or sorry, we were talking about capital structure.
No, in general.
In general,
yeah. I would say
still cash.
Cash is always it's always top of mind. Always top of mind.
And also cash was not only to ensure that we have enough buffers, but also to optimize the usage of cash. It will be key, and especially in a year in 2024, seems to be a very uncertain one, macro-wise.
What has been some of the when you talk about cash and cash optimization? What have you found out? Here's some trapped cash, or here is cash that we're not using optimally. What has that been?
We don't have any trapped cash. I'll tell you that.
We pull all levers. But a tough part of cash modeling has been, I think, VAT flows. That's always it should be super straightforward and efficient, but it proves difficult when.
Yeah, VAT flows they become it's just cash in and cash out, right? But they become substantial when you scale and also when cash is tight, it's a fairly big amount that you need to keep an eye on. Because if you get a quarterly VAT bill that needs to be paid and the cash balance is low, then you run into difficulties. So one shouldn't underestimate the modeling of the VAT flows.
It's tough to extend payment terms with the tax man.
It
They're
is.
not always very keen on supporting.
No, but I guess that's also another layer of complexity when it comes to international expansion, right? And the VAT in different jurisdictions, and when each respective taxman should receive their bill.
One surprise in the early days for me was the flexibility for among the suppliers to help you in extending payment terms. That has proven very beneficial for us. Pick up the phone, speak to them, and tell you your situation, and provide a solid forecast plan for how this payment profile will look like, and say, hey, would you be open to extend this with another 3 months? I give you 1/3 per month. I was very surprised to see them being so flexible in that regard, and that obviously has a huge impact on my cash flow. If you get another 3 months from a main supplier, it's like ching ching.
Yeah.
So close collaboration with the suppliers is vital, and to build a good relationship, because you need them when the going gets tough. The banks will not be as agile.
It's a quid pro quo. I mean, they come to us and ask for favors. We grant them favors, and
they obviously want us to thrive, right?
We're good business.
They're very keen to lend a hand.
I mean, that sounds like a very fortunate position to be in. As we speak to multiple customers, and you find that some are in complete opposite situation, i.e., that they have zero bargaining power, and a delay of say 10 days of shipment can be absolutely catastrophic for the cash flow, right? And like you said, quid pro quo. Okay, you had a delay 2 months back. Now we need a favor.
Yeah.
That makes a huge difference cash flow wise.
Yeah. And just important to be nice, and to whenever if they mess up with the late delivery, as you say, don't burn the bridge and start to yell at them, because you will need them one day potentially to help you on the other end with your cash flow. So treat that relationship carefully.
So cash, obviously top of mind. I think it's for everyone, especially in this climate.
And have enough buffer in the cash.
Yes.
In the cash in the bank account. Expect the unexpected and build for an uncertain 2024. Allow yourself some margin in the cash flow modeling.
Tech stack you're more or less content with today. You're implementing the ERP. Do you see any other potential future bottlenecks that you're thinking about already when it comes to your tech stack?
It's a good question. I think maybe with the establishment of more subsidiaries, we're going to need some significant expansion on the accounting side. So that's a hurdle we're looking at. Better BI in general. That goes into the ERP.
More detail or more
detail?
More detail.
Yeah, more detailed. And we have now a data analyst interning with us to just help us become better at data. And so far the improvements we've made, we see the direct effects on the P&L. So the better we can be with data, the more efficient we can be. And AI, of course. We have it's not finance related really, but AI can be leveraged in a lot of aspects of a clothing brand. You don't really think of it as such. It's so physical, but in content, for instance, just mood boarding, different campaigns can save a lot of money just through really, really great tools that are out there. Midjourney is a good one.
Not so much a tech stack comment, but on the finance team comment, one thing I would have done differently is to bring in the accounting team in-house sooner. We still have ours outsourced, but it takes a lot of time and effort to communicate with such an important external party. So to have that person in-house, I am 100% sure that will benefit the finance function.
Definitely. And I feel like they almost have a tendency to a little bit lure you in, the outsourced accountants, where they say, this is your monthly fee and this is the work we're going to be doing and it looks great. But then if you're in a business with our size, with our relatively slim consolidation of invoice management and the like, you always get things tacked on to the bill. Every month there's something that has
and
to
all
be
of a sudden
done.
you have an FTE in that cost.
You have an FTE, exactly. But
Yeah.
you have an FTE that you can only communicate with through mail or through telephone, which is, I would love to have someone sitting next to me, Jesper, just...
It matters to just turn over your shoulder and speak to someone.
Yeah, exactly.
And I think you can also leverage that resource in other functions in the team. If you find the right person, so not being only bookkeeping, but also to help out with analysis and data and stuff for the other teams. Take that person in-house sooner rather than later.
All right. Well, I mean, CDLP has been on an absolutely amazing journey. It's incredibly strong brand, and the growth that you're seeing, particularly outside of your home market, is nothing short of impressive. So it's been absolutely amazing to talk to you guys, get your insights. So thank you very much.
Thank you for having us.
I have one final question though. What's your favorite Excel shortcut?
Ooh. I built my own, actually, a micro, Control P.
Oh, okay, next level. Okay, yeah. VBA scripts and okay.
Phrase President shortcut is my favorite one. It's invaluable.
I would say because Jesper plays a lot of value in formatting. So I say Alt HOW to set the column width.
Okay.
Make sure that they're all
equal size. Yeah. Okay.
Wow.
Yeah.
Am I that obsessive about formatting?
Yeah, you are. Think about those things.
Yeah.
Good.
Well, mine is Alt AEDST, which is pay special format. So maybe I'm in the Jesper camp here. I'm sure. All right, guys. Thanks a lot. Really appreciate it. It's been amazing.
Thank you. It's been a pleasure.